Well, welcome to our weekly High Rock video. I'm Scott Tomlinson, and with me is my partner and colleague and the founder of High Rock, Paul Tepsich. And we're going to chat about what we see happening in the global economy and financial markets and the world of wealth management and how we are adjusting our investing strategy accordingly. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at www.highrockcapital.ca. And as you know, we have three models that we utilize to create our portfolio strategies. Last week was generally a good week for our client portfolios with a weaker Canadian dollar and bond prices a bit stronger. Paul, any recent developments you might want to chat about?
Position-wise, no. The only thing we did do is we entered into I'll say a new position in the tactical model, but it's actually an old one, but we sold out of it entirely back last fall, maybe in November. I'd have to look it up. And at this stage, this company reported earnings a couple weeks ago, and I thought they were actually quite good, and I went through, put them in my model. They looked good, and the stock sold off. I've read through some research pieces from street analysts, and I started buying the stock. Well, put in an order last week, and I think we just got filled on a small amount yesterday, so we're going to continue to add to that one. It is a dividend-paying stock, which I'm not always crazy about, but I think it's got a very good valuation right now, so I'm taking advantage of this small sell-off, and we're buying it back at a pretty good discount to where we sold it last fall.
Excellent.
That's really about it from position changes.
What about Cobalt? You want to talk a little bit about that?
Sure. As everyone's well aware, this is one of our new themes that began last fall. Cobalt is a metal that goes into manufacturing batteries, and there right now really isn't a really good substitute for cobalt. I won't get into all the reasons why, but 65% of the cobalt in the world is mined out of the DRC, which you would know is not a really stable environment, and they're actually just putting a supersized tax on miners in the DRC right now. And as you can see by that chart, over the past 2 weeks, it's driven up the price of cobalt pretty substantially. And again, the next chart, you can see we own Cobalt 27. And Cobalt 27 right now is really a vehicle, a company that is raised capital through equity issuances, and they are looking to do a large streaming deal, which effectively they would go into a miner, a cobalt miner, and pay them up front for X% of their production every year. So it's really a financial arrangement that they would have with a miner. Companies like Franco-Nevada do this in the gold and silver markets, or the old silver, wheat and precious metals. These are all royalty and streaming companies, and that's what Cobalt 27 is, but it's focused just on cobalt right now. I think this thing will start gravitating quite a bit higher here. They raised capital, as we said. We sold our stock, half of our stock, around $13.57, and we bought it back on an issuance at $11.40, which it didn't even print at. It was private placement. So we were lucky enough to get stock there at $11.40, and now, as you can see, it's trading up around, I think it closed today at $13.30. So it's been a pretty good trade so far, knock on wood. But I think there's a lot more in it. They say they're really close to doing their first big streaming deal, which should probably be around $200 million worth, which is the amount of money they raised 2 weeks ago in the equity markets. So we'll see what happens over the next 2 to 3 weeks, and hopefully that comes to fruition. But at this stage, it's otherwise backed by, I just closed my model on it, but it's backed by several thousand tons of raw cobalt. So there's a the downside risk is somewhat taken care of here, because the net asset value per share on this stock is, in my opinion, is around $12.10 of the value of the cobalt, the cash on the balance sheet, and the certain small royalty streams that they already have on the books. Anyway, that's it for cobalt.
Yeah, no, but that's great because we talk about how in general we find the global stock market to be quite high relative value, and it's important that we find other opportunities to create value, and that's why the tactical model becomes so important as a third option for our client portfolios. And as we've been pointing out, and as I just mentioned, the stock market, especially in the U.S., has outpaced economic growth certainly since the last recession, and in anticipation of better economic growth and earnings that were expected to follow. And we believe that at some point the fundamentals actually need to realign themselves as they have in the past, in 2000 and also in 2008. Um, but either economic growth has to catch up, or stock prices have to fall, or perhaps a combination of both. But uh, with the latest U.S. policy changes, especially lower corporate taxes, economic growth and earnings growth expectations have been raised, but the economic data is yet to show signs of a follow through so far this year. And last Friday, the latest release of U.S. data prompted updated expectations of U.S. economic growth for the first quarter to be lowered to a reduced rate of growth of 1.8%. Now, the consumer has been unexpectedly quiet so far this year. Retail sales have fallen off despite higher levels of consumer confidence. And tomorrow, the U.S. Federal Reserve is expected to raise rates by 0.25%, which may further influence what the consumer is able to do because they're sitting on record levels of debt. Well, technically, investors are still oscillating between buying and selling and unable to find the confidence to instill buying strength to move the market to new highs, but not yet prepared to extend selling to test the recent lows. If the lower trend line breaks down, it may in fact incite longer term equity owners to reconsider their commitment to the market, which could bring in fresh selling. And we think that this may be certainly a bigger risk out there, given the relatively lofty valuations and the lack of any upside momentum at the moment. Paul, any comments?
I don't really have any. Obviously, yesterday being Monday was a pretty significant day, and everybody's probably aware of the Facebook news it says there. I think that's obviously one of the big so-called FANG stocks: Facebook, Amazon, Alphabet, Microsoft, Netflix, Google, that have been driving a large portion of the upside move that we can see in this chart over the last year. So, when some of those big names start faltering, it does make you wonder about how the market's going to respond and behave.
Yeah, and we've seen this uptrend for almost 9 years now, or actually right on 9 years for that matter. And the higher levels of volatility often suggest that there could be at least the beginning of a trend change, and there's a good chance that there may be another test of that long-term uptrend in the not too distant future. Our belief is that that is probably more likely. Continue with the bullish trend before the bullish trend can continue to move higher. The bullish trend has to have confidence to do so, and at the moment, it doesn't appear that confidence is running that high, right?
No, and if you're looking at that chart too, I mean, it's somewhere around the 22,000, or pardon me, 2,200 mark in the S&P. That's about a 20% drop, right?
Yeah.
It's fairly substantial.
Yeah. Yeah. No, and we're not, it's not without reason that it could actually do that. I mean, the fundamentals that we talk about uh, regularly, um, are still, they're still favorable. Earnings are expected to show substantial growth in 2018, but prices are well ahead of the 5 and 10-year moving averages on a relative basis. And with all the earnings growth built into the current pricing, that's a lot of the good news, but not a lot of the bad news is built in. And when we get bad news, like we did, as you said, with Facebook yesterday, it does rattle the market somewhat. So I think generally there is greater potential for the market to get rattled because that bad news just isn't built into the outlook.
Yeah, no, agreed.
So again, we've been talking about the yield curves each week. We look. The yield curve had started to actually steepen out a little bit in February, and that, to a degree, was the catalyst for some of the volatility in stocks. But since then, we're actually seeing the yield curve now start to revert back to that downward trend. Just to remind everybody, the yield curve is what we call the difference between the 2-year government bond yields and the 30-year government bond yields. We're seeing 2-year yields relative to 30-year yields moving higher, and that flattens the yield curve. Now we tell everybody each week, but as that yield curve approaches zero, that brings us, from a historical perspective, it brings us closer to recession. And the same in Canada. And the news coming out of the Canadian economy is not good, right, Paul?
Not at all. No, it's there was a few of my former clients and counterparts that were in the paper last week or on the weekend talking about how Canada is really not a great investing climate right now, and I think we've seen that in our lower, flatter yield curve, lower rates, lower stock market returns, and weaker Canadian dollar. But we've talked about that before.
And the Canadian dollar significantly weaker since the beginning of February.
I just read yesterday, speaking of our investing climate in Canada, specifically in Ontario, Ontario is the largest non-sovereign debtor in the world right now. And we spend $1 billion a month on interest to service that debt, which I know you talked about a couple of years ago. It was very interesting. Is that it's just like running a household. If you're servicing that amount of debt, it's really hard to get some growth. Really hard.
Yeah.
So
it's hard to do any spending if you're servicing significant amounts of debt and your interest costs start to rise, right?
Yeah, think about it. The province of Ontario spends $12 billion a year just in interest only. And then, every dollar of debt you add increases that even more. Like it's incredible.
Yeah.
Anyway, I think that's part of what's going on in Canada in general.
Well, it's a great segue into the fact that it's tax time. So on an administrative note, we want to remind all of our clients that you should have received your T4s and T5s, but that the T3s take a little longer, and companies have until the end of March to send them. So you may have to be a little patient waiting for the T3s before you send all your stuff to your accountant. As well, we have, as of yesterday, physically mailed the fee summaries for 2017, as well as gain loss reports where they are applicable to your specific situation. So please let us know if you require any assistance with any of these reports. We stand by, and please contact us if there's anything we can be helping you with. But that's it for this week. Thank you to those who have offered some feedback on our format. I really appreciate it. It's very helpful. And for those of you who wish to, we would invite you to keep it coming, and please feel free to ask any questions that you might have. There are no such thing as bad questions. But on behalf of Paul, Bianca, who returns to full-time as of the beginning of April, and myself, we wish you a great rest of the week, and we'll be back next week with an update.